Good morning, traders and investors. Today is March 3rd. It's a Tuesday. Hope everyone's having a good morning so far. We got the Triple D back in the driver's seat. Maybe he's riding shotgun. I think he's riding shotgun today. We're going to get you some updates on the conflict in the Middle East, some news that happened overnight. International markets having a tough time here this morning. This is one of the biggest moves here in a name like the EEM or the EWY in quite some time. We're going to talk about counter trend moves and why this is important in this market right here, right now. Seems like the SP is pricing in no risk. We want to consider why that might be the case. Oil trading up another 7% here. We'll get to that in a sec when I do the rundown. Couple earnings overnight. MongoDB, Credo, Target this morning, Best Buy, and ONON. Pinterest getting a big investment from Elliott. Hopefully, we'll be able to get to those, but the main focus, folks, of course, is going to be the conflict in the Middle East and implications. Statman Ryan Dietrich coming up at 8:35 a.m. Eastern time. Statman will have some awesome info for us, as he does always. Folks, let's get it going here on Pre-Market Prep.
The volatility right now is really incredible.
Wow, look at that consolidation on the upper right chart.
You know what we've seen this earnings season? Some of these expected moves get even more violent. This is why I have switched my strategy 10 years ago. And if you're chasing, you're in trouble.
Pulling up the charts here, folks. We are getting started with S&P trading down about 1% here this morning. Looking at the SPY Qs trading down 2%. Let's do the IWM, the small caps, and the Russell trading down a little over 2%. Here's your big one, folks. Of course, oil trading up another 5, 6, 7%. Little perspective, though. This is a level in oil that was happening as recently as like June or so. So, I mean, yes, this is a monster move in oil, but, zooming out a little perspective there. Take a quick look at gold GLD trading down almost 3%, about $13 per ounce. Silver trading down. I don't know what's happening with the quote there on screen. We'll just skip silver for now. IBIT and Bitcoin. Good old trusty IBIT trading down about 2.5 or 3% here this morning. These charts, folks, are brought to you by TradeStation. Born to trade. Chart, analyze, customize, all in one platform on TradeStation, one of our wonderful sponsors for pre-market prep. Let's bring in Triple D, see how he's doing this week. Triple D.
I'm alive. Just been the worst flu/cold bug. I'm on day 10 of it. Still not going away, but I'm here. I'm functional. I'm just really stuffed up. So ignore the nasally voice. We're going to try to fight through for you guys here today. Overnight action here is incredible here once again. You get the sell-off. We saw this yesterday. Significant sell-off overnight. And then what happens? They just buy the dip. But give us some catalyst, some macro picture here, Brentster, on why we have sold off here overnight.
Sure, and I'm just going to pull up the SPY chart here into maybe like a 15-minute chart, see what's going on. A couple updates from overnight in the conflict in the Middle East. Yesterday, during the day, during the market session, Trump saying that the U.S. was ahead of its timeline of 4 to 5 weeks for this conflict with Iran and in the Middle East. However, he did say that this could be extended. He basically was saying whatever we need to do to end this threat, at least according to him. Overnight in the Middle East, Iran did strike the U.S. Embassy in Riyadh, Saudi Arabian capital. Also, the U.S. Embassy in Kuwait was targeted. I don't believe there was an actual attack on the embassy in Kuwait, but it was, quote, targeted. Israeli senior officials saying that they are now in the country and the IDF is now in a, quote, open war with Hezbollah. We did hear late last night, as Triple D and I were in the STN room, that there were air raid sirens in Jordan. And also, here's probably one of the reasons why oil is trading up so sharply again here today. The Strait of Hormuz was closed as of around yesterday afternoon. Just conflict happening all over the Middle East, basically, to sum it up. International markets certainly did respond triple D overnight. Why are international markets so important to have on your radar?
Well, there's been a lot. It's been the best place to be. European markets, Asia has all outperformed the U.S. markets here for the last year. So there's a lot of money hiding there. I mean, EEM has been up, 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 52-week highs. EFA, new 52-week highs just as soon as 2 days ago. And now, obviously, this war is over. It's over there. So, I mean, when you start thinking about, like, in all context here, I mean, it's more affecting businesses over there. And obviously, you're looking, it doesn't look like it's going to end imminently here. I think maybe we had some optimistic over the weekend where, well, this could end quickly, kill the supreme leader on the first day.
Right.
I mean, it seems like it might end quickly. Now it starts to look like it may be settling in a bit. So a little more realization here this morning that, hey, this may not be over as quickly as the markets would like. So you see significant sell-off in EEM, but this is a big counter trend move, folks. 4.67% down. So you've had, an ETF that's been up to, just continue to go higher, higher, higher. Hits, 63.43 the other day. And now you're talking an 8% fall in 3 days. EFA, same story, down significantly here this morning, down almost 4%. Hits new 52-week highs yesterday, just 2 days ago, 105.94. Then bang, bang, down 6% 2 days. So you're catching the international money manager now a little bit here too, where they've been good. They haven't been impacted by, the U.S. slide, and some of the momentum stocks. So it's been the place where money managers have been hiding. Today they get hit as well. Even myself, I have a lot of international in my portfolio, my long-term account. I get hit here as well too. So more international markets feeling it now today.
And, just as this is spreading, more and more nations are getting pulled in. So, I mean, it makes sense that there are international markets that are reacting. China also commenting. We were looking for the exact comment. We couldn't really find it, but basically China is not pleased and said the US and Israel and Iran and some other Middle Eastern countries need to basically knock it off. And I was like, Dennis, why does China care about this? And he was like, well, oil prices is everything.
Yeah, they get a lot of oil there, and this is going to impact them directly here too.
Absolutely.
So especially, you talk about just the repercussions of all of this. I mean, it's not like going into Venezuela and it's in and out in a day. Like, Trump has said, we thought 4 to 5 weeks. You hope that's the optimistic, like, this could settle in for a while here now. And somebody was saying, now that, Iran's in the air here, it gets trickier again. So lots to consider, lots to think about here. I mean, the war trade, let's just go to that for a second, because those stocks, were really good for me over the weekend. I was long Lockheed Martin, long NOC. Both those stocks made my day yesterday because they were up substantially. I sold overnight. In the pre-market, they did come back in. We had some reversals. AVAV lost a contract and just had a violent reversal yesterday. But the war trade is still on. Oil stocks still up. Question is, is this the place you want to be long term? Wars do end. And usually, actually, wars can sometimes be bullish for stocks. So the question today is like, are you coming to buy the dip? I mean, is this another opportunity? Because yesterday, the dip was bought immediately. And why do we see this? Let's stop for a second, just talk about, why are we seeing, really the script has changed? Because if we look over the course of the last few years, it seems like markets rally overnight and then dip during the day. We know we have statistics to show the last 20 years even, of the same, where, retail is predominantly usually bullish. They come in, if the stocks go down during the day, they like to buy the dip at night. A lot of these traders trade overnight. They can move prices up. Lately, we've been seeing the opposite. We've been seeing actually the market sell off overnight and rally during the day. I've got a theory here, and obviously, we don't know who the market participants are, but I think retail has really been hurt. I think that they've been hurt the recent sell-off. You can see a stock like Robinhood that has, fallen from 150 to 75 bucks. And there's a lot of people not only long this stock, but a lot of the stocks that, Robinhood traders have, like the Palantirs of the world. You could go into some of the smaller names, the stocks with the nosebleed cool stories, but no profits. Those stocks have all been crushed. It's the value stocks that have held us up, the broadening out into the value market that has held us up very well. And those stocks, aren't retail darlings. They aren't the kind of stocks that they love. Yes, money managers love those. Yes, I like those. I like value stocks. I like low PE, but it's not those kind of stocks. So my theory really is that retail has been hit pretty hard. And a lot of the retail traders are spooked to be just coming in buying the dip, and they're nervous. And they sell overnight when they see, action happening. We see that again too. And overnight action is predominantly retail traders.
Yeah.
Intraday is a lot of retail there too, but it's predominantly institutional traders. So institutional money manager is still pretty diversified, still doing pretty well. They weren't at all the nosebleed names. Sure, there's some funds that are the nosebleed names, but the value market has helped them. They're feeling pretty good still here. So when they get a dip yesterday, they're like, come on in here and buy the dip, because they feel like, and one thing to consider when you're an institutional money manager, you're managing someone else's money. When you're a retail trader, you're managing your own money. So they can come in and blindly buy the dip with more confidence because it's not their money. And I mean, that's the truth.
That's interesting.
It is. So, and their whole objective, if you're, an institutional money manager, is to outperform the benchmark or outperform the next guy. So when you see a 1,000-point fall in the Dow, or 100-point fall in the S&P, institutional money manager will come in and buy the dip because they're like, hey, I'm buying cheaper than my competition did yesterday. So that's going to, allow me to outperform the markets overall. So that buy the dip mentality just exists because there's so many money managers that continue to get rewarded for it. Does that happen here again today? I'm not going to bet against it. Buy the dip has been the best strategy in this market for the last 25 years. So it's hard to be selling the dip. I just think we're in this market that is just pricing at no risk, though. The market is full on like, S&P in itself, certain stocks have been crushed, but the S&P has just been like resilient, so resilient, 2% off the highs yesterday. We got AI, not knowing where that's going. We got the war on, and the S&Ps are sitting here, we don't care. I mean, do they care this morning? They all of a sudden wake up, or do they not care by this afternoon? I won't bet against the institutional money manager buying the dip.
All right, so you gave us a couple good hints there. We know you're looking at a Lockheed Martin. We know you're looking at a little Northrop Grumman. How else might you be looking to, position yourself into the open?
And I'm out of those stocks. I'm out of those trades.
Yep.
So those were trades that I put on over the weekend. I've been putting those trades on overnight because as, escalation happens, it seems like overnight, those stocks get overnight lifts. Those are good overnight stocks right now. I don't know if they're good intraday stocks.
Sure.
Because this action is like really being talked about when the markets are closed and it's overnight. So consider that. So it's not like I'm coming in here buying Lockheed Martin right now. I think you're doing it backwards. So I think, those are good overnight trades, not so much intraday trades. So, I just look here. There's so many repercussions here. I mean, look at NVIDIA here. So NVIDIA wanted to get bought yesterday. It did. Had a key reversal. What happens? We get sell off overnight. NVIDIA's right back down. There's huge support down here, 170 to 175. It's still going to lead the AI, and if you're looking forward, 2027 earnings on NVIDIA is 16 times earnings here now. So, I mean, a stock like this coming into major support in the 170s just kind of makes a lot of sense that this is a stock that people are probably going to buy the dip on. Does it mean, that we're out of the woods here? I've been in de-risking mode here for a while overall because I think like the S&Ps being 1 or 2% off the highs with this much risk, that's what I've been talking in the STN room too, is I've backed off some of my long strategies because I'm just like the overnight risk is just too high right now. So as a trader, you have that luxury. As a money manager or investor, you don't have that luxury. You need to buy good companies at reasonable valuations. NVIDIA is a great company at a very reasonable valuation here right now. I have a huge position in my long-term portfolio. I've considered actually adding to it at these levels.
And you got to think that NVIDIA is, widely traded by institutions intraday, right? So to your point,
it's just the ultimate buy the dip stock. One of those. It's been the ultimate buy the dip stock. Now, that doesn't mean it's going to bounce right back. Like I put it in context here. The risk in this market, folks, is not being priced in. There is huge risk in this market. Just imagine that Iran, and you don't want this to happen, ends up like throwing a missile at a major European city. There's major casualties. What does that mean? Like we're in that situation. There you got you put somebody against the wall, who knows what's going to happen here. So I mean, this is scary. So I think the best spot to be right now, personally, is cash. My trading account goes to 100% cash. 100% cash yesterday. I have some positions on right now, but I intend to be 100% cash at 9:40 a.m. today in my trading account. Investing account, I've been buying bonds. I've been like sitting back and de-risking here. I've been in de-risking mode for a while. So it hasn't been the best place to be, but I feel like I'm just nervous on this market here right now. So I've been in de-risking mode here for quite some time.
I mean, let's go back to your 4 pillars for your investment strategy right now. It's necessities, it's energy, it's hardware, and the
Yep.
one that you added and maybe the
Cash
most
and bonds.
maybe the most intriguing and
Yep.
maybe the most
Yep.
important in this environment, bonds, cash, TLT here on screen right now.
Well, and maybe TLT is not the place to be. Maybe you want international bonds. There's all kinds of different bonds. So I'm just saying TLT because it's widely traded.
Yeah,
There's all
of course.
kinds of different places to be here. There's a dip here the last few days. They're like selling, and again, maybe selling US, is a thing, it's been happening too. US dollar, is obviously not been a great place to be. So there's lots of different places to be. But all I'm saying is right now, if the markets, are going down and you're in cash, you're up 1.4% relative to your competition today. So, you're sitting there, look at Warren Buffett, Burke.B with the 40% cash where he's got. We're down 0.4% here today because he's got a lot less stocks than you do. I think the risk is just really high right now. We've been in this market environment. People expect 20% returns every single year. Spoiled.
Yeah.
We have
Yep.
not had a prolonged bear market in 15 years. Yeah, we had the COVID. It lasted 2 months. People have not been severely punished at all. I'm not saying that's going to happen, but I'm saying my job as a trader is to read risk first, then return. The risk here is incredible, man. It's so incredible. So do I think this market's blasting off without me here? I don't think so. We've been going nowhere on the S&P for a long time. So moving a little bit to the sidelines right now, or keeping, backing off on long-only strategies is prudent. My trading account is at all-time highs right now. All-time highs. All-time high again over the weekend. Why? Because I move it to cash. And you know what? Markets fall. I'm not getting dinged. Now, my long-term account, because I buy good companies, reasonable valuations, get dinged with everybody else because you're just investing there. You're doing different things. But even in that, I'm trying to raise up cash a little bit here because I've been fully invested for a while. So I'm trying to just reallocate a little bit here. It's a lot of risk out here right now. And that's not even talking about the AI situation, which is all we were talking about a week ago. Now we had Iran on this whole thing. We had a war on this whole thing. China's pissed off now. I mean, there's so many things to consider here. So if you're coming in here into this market thinking, how can I make so much money right now? I think you're looking at it wrong. I think it's how to protect your capital, and maybe you put your money to work in some places where it hasn't been working lately. And that's what's worked all year. It's been the value stocks that have been working. Those are the stocks that everybody's hated for the last 5 years. Those are the ones that are working now.
Capital preservation mode. And while you mention it, let's just take a quick look at the IGV. Mitch and I yesterday we were framing the war and the conflict over the weekend, but we had to say, IGV and the software AI disruption is still very much happening in the background. For better or for worse, we kind of have to put it on the back burner. But I mean, look at the IGV, chopping around here a couple of days. Hasn't really made a decided move even after we got
it's
that
oversold.
little relief.
It's oversold, and maybe in some of these places you do want to put some work. Maybe in your long-term investing account, you're saying, look, this AI stuff's overdone. I'm going to go buy, some of these, software companies right now because they're really overdone. I mean, which brings us to Bill McDermott at ServiceNow. He told us he was going to buy stock. He literally told us he was going to buy stock he gave us the date because the first day it was available for him to buy stock was on the 27th. We told you guys that. And I bought it last night. That NOW ahead because I'm like, well, we're probably gonna get that filing. Happens 5 minutes after the close. We get the filing. ServiceNow pops $1. I sold into it because I'm like, I can't believe it wasn't popping more, but that's how much they hate these stocks right now. So you get Bill McDermott. How many shares? He didn't buy a ton, but he's not done yet either.
It was like 24,000 off the top of my head. I can double check real quick, but it wasn't it wasn't a ton, but like you said, it was actually almost 29,000, let's call it, but we don't know, I guess, if he's done. It probably seems like he's not done. But since that pop, I mean, if you look at the chart here, I can zoom in the chart a little bit. If you look at the chart here, I mean, that pop was tiny. The pop was tiny, and it's just been faded, with the rest of the market here this morning. It shows you where the market's focus is, I think. Want to go to some earnings, Triple D? You want to go to Pinterest?
Well, yeah. So Elliot's coming in here, and they're adding more. We know Elliot's already been in Pinterest, but they're pissed off because the stock's going down, And they've been in here for years. Like Elliott has been in Pinterest for, I don't know. I feel like it's like 5 years here now. The stock is in the gutter. The business is in the gutter. They've boosted up another, they had another $1 billion into,
Yes.
into Pinterest here.
Yep.
Talking about share repurchases, trying to get in there and cause some, cause some shakeups. They need some shakeups. It's been a mess.
Yep.
Does that mean this 10% move is, oh my God, Elliott's in there? They're already in there. We already knew
They've been in there since 2022. We knew about an investment since 2022, actually since maybe even midway through 2021. And Elliott has been like engaging with Pinterest management since August of 2022. They announced a partnership with Elliott in December of 2022. So I like how you're highlighting this, Dennis, but just to mention here real quick who the heck Elliott is. I mean, they're definitely a top 3 activist. Is that safe to say?
Yeah. Oh no, for sure. I'd say almost number 1. So
there
it's
you
a
go.
huge name.
Yep.
When Elliott
Paul
comes
Singer,
in, stocks
founder.
pop. Yeah. When Elliott comes in, stocks pop, and they've added. They're like, they're buying their depth. They're buying their own heat. But stock's been a mess. Is Pinterest really where I want to be? Like, think about this as a logical investment here. I mean, holy crap! It produces, and pools online images is really what it does. I mean, that's what this business does. This is like AI, like gonna murder this. Like, this is like just AI ground zero. So I'm not buying the stock at all. I'd sell all rips. Sorry, Elliott. Hate your stock.
That's okay. That's okay. The thing about Pinterest is it has a bit of a cult, like the service, the software, it has a bit of a cult following. Yes, there is, a group of people that really love Pinterest, but as far as like using this to decide what you want to do for an investment, I mean, seems like quite a stretch here. Let's get into a couple earnings reports. You want to start with a couple from last night, MongoDB, Credo, or
MongoDB.
ASTS?
So we talked about low bar for MongoDB last night. I'm like, it has a low bar. They don't care. It's software. They just like crush it. Give us the numbers here, Brett. I didn't think they were this bad, but market doesn't care. Hates the stock.
Pulling up the chart here now, and then I'll read you the numbers. You can see how much the stock is trading down here this morning. 27%. Is it really down that much? Darn. Company reporting a solid quarter. I would call it a solid quarter. Q4 earnings, $1.65. Analysts were at $1.45, so a nice beat there. Sales also a decent beat for the quarter, around $695 million. Analysts were at around $670 million. Guidance was the concern for the quarter, in my opinion. They're expecting Q1 earnings $1.15 to $1.19. Analysts are up over $1.20. The sales guidance was also on the lighter side of things. The fiscal year 2027 guidance was fine. They're expecting $575 to $593 in earnings. Analysts were around $563, and the sales guidance also solid there. Let me zoom the chart out here. Again, MongoDB shares trading down 27%. Let's zoom this out and see where we are in the context of MongoDB. I mean, this is just to say the obvious. I mean, this is pretty ground zero for AI disruption. Am I wrong?
Yeah. I mean, just look at all the stocks reported here last night. So let's just go through them all because it's going to be fun. We're going to get Ryan Dietrich on here in a few minutes. I mean, so you can go like GRR, Gorilla Technologies. It's down 4%. I'll let you go through these charts here.
Okay.
BBAI, down 5%. QUBT, down 4%. Plug Power, there's a buck in the trend. $1.81 stocks up 12%. Whoop-de-doo-da day. CRZ, down 3%. MDB, down 27%. CRDO, down 11%. That actually didn't even have that bad a report. And I got beat up on that because I thought it might bounce and I played it into the earnings. And that was a dumb move. But yeah, I'm the only one that loses money actually sometimes. ASTS, down 0.6%. I'm going through all the stocks reported last night. TRE, Lending Tree. Well, that one's up 8%.
That was a good report.
Asana was okay. It's down anyways, down 3%. I mean, do you sense a trend here? I mean, this is just the type of market where even if you have a good report, it's hard to go up. Now, Target bounces, value name. But then you got SE Limited, down 15% this morning. On, down 13% this morning. AutoZone, down 5% this morning. Best Buy. They're like Best Buy and Target. You know what Best Buy and Target have in common? Ridiculously low PEs. So, I mean, it's that simple right now, folks. It stays in that market here where you got a lower PE. They're giving you a pass. Target's PE is 13. That's the forward PE on Target. Best Buy PE, grabbing it for you, it's 9 times. 9 times forward earnings. It's 5.56% dividend. These are the kind of stocks that are continuing to perform in 2025. So it's that simple. You got to stop worrying about like story. Story was cool the last 5 years. Oh, it's got a sexy story. I want to buy that. You know what's sexy right now is value. Lower valuation stocks. Those are holding up. And even on these earnings, like you could go to a MongoDB and say, oh, you know, well, it's come down. Yeah, it's come down. It's still trading 57 times forward earnings. Now, again, that's probably because they lowered guidance. I mean, that's an adjustment there that's already been made here. But, I mean, these stocks are not cheap. So this is as simple as the market's going to get here. Like, you look at MDB. It's going to make $5. So make $5 a share. For the whole bloody year, 2027, they see $5.93.
Yeah.
Stock's $300. I mean, like a PE of 10 is 50. I mean, these stocks are just too bloody expensive. So what's happened is the sexy stories have just driven price on all these names, 60, 80, 100 times earnings on some of these names. It never made any sense. And you're having a re-rating to the downside on the overvalued, storied stocks, and a re-rating to the upside on the undervalued value stocks. That's maybe going to continue.
Don't say we didn't tell you. Triple D has been talking about value sexy. We could probably go back and look at one of the show titles from maybe
3 months ago.
Maybe November, maybe December. I do want to stop here real quick on and just get you the results from the Target and the Best Buy, because I think they were notable, just to mention.
Yeah.
Target report was solid. On the bottom line, earnings of $244 versus a $215 estimate. Sales did miss though, but very modestly. The guidance was strong, straight up strong. They're expecting 2026 earnings $750 to $850. Analysts are all the way down around $765 or so. The sales a little bit more in line, but the quarterly guidance wasn't quite as strong. But I think investors here this morning focusing a little bit on that fiscal year guidance, and more so focusing on a nice cheap valuation. Let's take a look at Best Buy here real quick. Just pull up the chart while I get the results ready. Best Buy reporting $261 in earnings. It was a decent beat. Nothing especially to write home about. Analysts were around $250. Sales did miss. A little bit of a trend here on the retail front. So remember that, folks, as we are heading into kind of getting into the middle of the retail earnings season here. Guidance wasn't great, but again, it shows you where the market's mind is. They're expecting 2027 earnings $630 to $660. Analysts around $665. Again, the theme is the PE, the valuation, not necessarily the results.
Well, there you go. Like, just they're actually guiding down slightly. Estimates were up at 666. I have guides 630 to 660. You're like, oh my gosh, they cut guides. Well, they're looking, they're still making $6. The stock's $61. It's trading 10 times earnings with a 5.5% dividend. And you know what? AI efficiencies, like people are like, think about like going in there, Best Buy. What are you buying in there? You're buying electronics, you're buying hard assets, you're buying hardware, you're buying stuff at this store that is needed right now. I mean, this is like a hardware
physical
technology
goods
store. So this falls into the hardware category that I was talking about here.
Yep.
It's trading 10 times earnings. So this is a stock I would buy on dips. I think I like Best Buy here, actually. And you know what? If you get AI efficiencies, maybe they can actually reduce some management costs, reduce some other stuff in there. Flattening their workforce is going to hurt a lot of people, but it's going to help a lot of companies here. And bottom line is, the stuff that Best Buy sells, a lot of companies need still right now. A lot of people need.
Doing the XYZ analysis last week, the job cuts, we did the math together. We got to $1 billion in savings, like easily. How much could a company like Best Buy, even being conservative, AI efficiencies for Best Buy, let's say a few $100 million, how much would Best Buy benefit from that? Like a lot, I would imagine.
There's a lot of possibilities here. And I think, that's why these low PE names, we can't just even consider, like, just the thought process. Really, it's really going to go back, because the Iran situation will last, maybe a month here, maybe a couple months. It's not fun, but the market will settle in and start to become numb to those headlines too. Unfortunately,
that's true. Yeah,
unfortunately, that's what it does. So it'll come back to like AI. And what is AI doing? Well, it's still going to be disrupting. We've got Claude still going like crazy here. I know it went down for a few hours the other day,
Yeah.
but working like crazy. So my buddy intern, who's at the chat a lot of times, just set up his OpenClaw. He was sending me screenshots from it.
Nice.
What OpenClaw is. He got his Mac Mini, went out, bought it, set it all up. He's got a real estate business. He's having the whole thing do all of its marketing for him. And he's like, just got to get it kickstarted. It's pretty impressive. He knows nothing about programming there, but he's all of a sudden got a whole marketing team with his OpenClaw setup. I mean, where we're going here with disruption is going to be incredible here too. So it's going to be winners, losers. I'm going to stick with my list from an investing standpoint. I keep saying it, but it's been working. I mean, even if you look at like Light yesterday, it was hardware. Why is it going up? It's hardware. Start separating your companies. Hardware good, software not good. Can there be a bounce in software? Yes. But we see, what happens, like, certain stocks that come into the earnings report, the bar is low and they still go down anyways because they're just simply hated.
Nothing exciting on the econ front today. I just wanted to mention, I want to just take a super quick look at our earnings calendar to get you set up for this afternoon, CrowdStrike this afternoon, GitLab. And tomorrow we get Abercrombie & Fitch in the morning. We get Bath & Body Works tomorrow after the close. We get Broadcom, one of our big tech names for the week, along with Marvell on Thursday. We do have Statman Do in the background.
Nice.
Ryan looks like he's getting set up, but that intro takes.
He's always ready.
He gave the thumbs up. Thanks, Ryan. That intro takes a little while, so let's run that Ryan Dietrich intro. Ryan Dietrich, Chief Strategist at Carson Group. How is your day? How's your week going, Ryan?
It's a lot better now.
Because of the intro.
I love that song. We
can send you a copy.
Yeah. I mean, maybe, I could play it every day. Like when my wife's yelling at me or my kids aren't listening.
Give you a little motivation.
I'll just play that song and say, people really like me. People do like me,
So
they
do.
Love you.
Yeah.
This community loves you.
There you go. Well, guys, thanks for having me back.
Of course.
I don't know. Do we have anything to talk about? I mean, I think we do, right? I think
boring.
Hang out.
So boring.
Yeah. I've got some slides. If you want me to share my screen, just give me a second here.
Yes, we are all dying always for your slides.
I've done this once or twice. Let's see here. There it is. Okay, you should see that in a second or two. Let me know if you see it.
Yeah, it's pulling up. All right. It says the first slide says some good news. Thank you, Ryan, for starting on an optimistic note.
Well, you're gonna laugh when you hear what my good news is. It's year of the horse. And animals that walk on four legs are bullish. So there you go. That's yeah. I
know it's the year of the horse.
You guys invited me. This is what
the fire horse.
Me. The year of the. I'm a year of the horse. I'm a 1978 guy. So year of the horse. So don't invest in this. I've got real stuff coming up, but I thought this is playful. That snakes and someone pointed out that dragons. I thought, what do you guys think? Do dragons walk on 2 or 4? Because apparently Chinese dragons are 4. I thought like American dragons, if there's such a thing.
No, they got their little like arms up here for like squat. They're walking on 2. I think they walk on 2.
And that tail's kind of a third in a way, but
it's like
I think 4.
They're walking on 2.
You're saying 4.
Okay.
Well, see,
2.
I went with
Makes
2.
a market.
I mean, it does make a market. So let's dive in, which makes a market too. So these slides that I'm going to share this morning with everyone on the show, and again, thanks for having me. It's always fun to join. Are something that Sonu Varghese and myself did yesterday for our Carson Advisors. So we're Carson Group. We're an RIA. We have. Yeah, pretty much. I mean, I think most of it's accurate from yesterday morning. We managed close to $60 billion after this morning. Maybe we're not quite there, but that's all right. Work in 43 states with over 500 advisors. So we manage a lot of money. And these are some things that we put together over the weekend, Sono and myself and our team, to talk again with our advisors about everything going on, specifically the Middle East. Obviously, I'm going to focus more on the Middle East today. So I think that's what everyone's talking about. So anyway, the big question that we have is, did the market know? Of course, nobody truly knew, right? But I mean, you think about it, you look at the leadership last month. I mean, it was utilities, it was energy, it was materials, the stuff that kind of made sense with what's going on over there. And crude, I mean, listen, Market's flat, S&P's flat, right? We know emerging markets, at least as of Friday, up like 14% a year. EFA's up over 10%. And I know both those areas get lit up right now, but they're probably due for something. But crude oil was that one that was always saying, something's maybe happening here. And I see crude's up another 7 or 8% this morning. So just some things we were thinking about. And the risk off was already kind of priced in our opinion. You have some defensive leadership. You have some minor cracks. We are still bullish. We've been bullish. We're still overweight equities. I'll get into how we're looking at the world here. I think after a 9-month win streak, we're a 10-month win streak on the Dow right now. Now I know some of them have been small, get it. But after the rally we've had, I've been on record many places. In fact, with you guys a month ago, said February is the banana peel month and actually goes into the middle of March. I've got a chart that shows that. So in that seasonally weak time, and we know, news trumps charts, no pun intended there, but that's where we are. But we did see some signs that maybe, there was a little bit of cracks under the surface. Now, let's remember this is a popular one with financial advisors, your community, more shorter term traders, I'm aware, but still it's big picture. We looked at over 40 of these major geopolitical events going back in history, starting with World War II. You can see on the right there, lots of big ones.
Yeah.
6 months later, up 5% median. Now, yes, some of them, but 73, 74. You got the tech bubble, the GFC. I mean, the economy was weak actually heading into those events, and then everything really, really fell apart. I've got some stuff on the economy, just a little bit. I know it's more technical discussion, but we think the economy still, we think the economy is still pretty solid. That one on the left, chart of fears, you can pick and choose. Well, maybe I should have added this one or should have added that one. The bottom line that we try to stress, and again, I'm more of a kind of a longer term. We manage tactical models, so think 3 to 6 to 9 months maybe, and strategic models, think 3 to 4 years. So I do live in a little longer term world, but these are things we really try to stress. Last April when we had that bear market, 10% drop in 2 days. I don't care who you were. We were bullish. That was very uncomfortable. I don't care who you were. That was like, oh boy, what's going on here? And then sure enough, we came back nearly just as quickly. So these are these things we really try to stress. So let's remember, these are fun ones, right? The January barometer. So goes January, goes the year. When January's up to 1 and 2%, like we were this year. All right, that's on the left. The rest of the year, I think it's the left. Yeah, next 11 months. Next 11 months have been lower only once. Something to think about. Then on the right, we're showing all the January barometers, and you're positive. You can see there, and it's kind of small for my eyes. What is it there? Yeah, higher 87% of the time. The rest of the year and the full year is higher, even more likely. So these are just little nuggets, and we stack all this stuff on top of each other. But I think that's interesting where we are. We might even be down on the year, actually. Well, we are probably looking at futures. It's like, well, we're down in March, but after the run we've had to have a first quarter where we kind of chop around and frustrate a lot of investors, we don't think it's too, famous last words. I think it's too concerning right now. We do have a target of 12 to 15% on the S&P 500. I'm a strategist. I hate to give targets. I want to be very clear. We are overweight equities. We have been for a while. We have probably about 60-40. We're probably about 69, 70% equities. But I've come with you guys for about a year now saying we have a lot of global exposure. We have a lot of developed international. An RIA the size of us, $50 billion plus. I don't know if many over the past year that have had as much diversification in their equity bucket that we do when we were specifically looking at developed international. We like developed international because look at IFA. I'm not wrong one. Look at EM. EM's up like a ton, but South Korea's up over 50%. Maybe this morning it's not. And a lot of that is AI. A lot of that is chips. You look at IFA, what do you think about when you think Europe? Well, you think industrials, you think materials, you think financials, not tech stuff, right? And I'm not saying we have a problem with tech. We own a lot of tech. When you manage a lot of money, we are even weight tech here, probably slightly overweight communication services. But the reality is we kind of like that area to get away potentially from some of the potential over the top with tech. Don't have a problem with tech, but we just think it makes sense to be there. So this is cool stuff that Sonu does. So Sonu is our chief macro strategist, one of the smartest, nicest guys I know. He and I do a weekly podcast called Facts versus Feelings. Sorry, had to give a little plug there. But this is something he's worked on for a long time. This is our LEI. Sonu looks at like 45 approximately different indicators. Now there's different LEIs, leading indexes. I'll just say this: ours 3 years ago, right now, said no recession. Everybody else is talking about a recession. The yield curve inverted, the SOM indicator triggered, the ISM sub 45, LEI negative year over year, the yield curve. Anyway, we all remember 3 years ago, you take a shot every time you heard this on CNBC, you'd be hammered by 10:30. But the reality is our LEI never said there'd be a recession. All of last year, we said our economy grew about trend. We grew like 2.2% on average to 4 quarters. That's about trend for our economy. We're still looking at that. Now, interestingly, we do this for like 30 different countries. We're seeing a lot of countries in Europe and Asia actually accelerate with their economic growth, which, again, I think is probably more positive than not. Now, listen, Sir John Templeton, This time is different, right? The four most dangerous words. If you hear anybody say that, what have all investors learned? Run the other way, because it's never different this time. But I'm going to say it. Whatever. We're amongst friends. The U.S. is a net exporter, right? Shale has changed the game. I mean, we can create a lot of pressure on energy prices, or maybe I should say put a cap on energy prices. We produce more energy than any, or at least not energy. We produce more oil than anybody thanks to shale. And this is just a way of showing, we've been net exporters the whole time. In 73, 74, when oil spiked, 1990, when oil spiked, other previous times, those two I'm going to focus on, though. We weren't a net exporter. We didn't have the shale revolution, right? I mean, so again, that's just something to think about. Can crude oil go to $100 a barrel? Of course, it sure could. It was 145 back in 2008. A lot of us old guys remember that was kind of really what broke the camel's back. I know the housing stuff, and I know the leverage, and we get all that. I think crude eventually going to 145, and I'm an old school John Murphy fan. I'm sure a lot of people on this call are, right? Message of the market, stockcharts.com, John Murphy, awesome guy. He says, late cycle, who leads? It's energy, it's materials, maybe parts of industrials. That sound familiar? It's where we are now. It doesn't mean, though, late cycle has to end today. Late cycle can last a couple years, and I think that's where we are. That's where we're positioning our portfolios, the money we run. I say if it drop it, hit your foot, it hurts. That's the stuff we've been owning. We have a lot of managed futures. I bet we have more managed futures than just about any other RIA coming into this year. How are managed futures doing this year? Spoiler, they're doing well. Okay. We've had gold exposure since March 31st of 2023 after the regional bank crisis. We always looked at the 40% other stuff. Let's forget about stocks for a second. 40% other stuff. We said, after 2022, what did we all learn? Well, bonds were not the diversifier we thought. How are yields doing this morning? How did yields do yesterday? You're not getting a lot of out of bonds. We have a lot of bonds, be very clear. But we think you should diversify your diversifiers. That's why we have some real assets, some hard assets, some managed futures, a little bit of gold. And trust me, we've got bonds too. But I've got other 40%. You probably should have a decent amount in the other stuff. And as a result, our models have done really, really well the last couple of years. And even year to date, we are after this end of February, the 7.4 billion approximately our team manages, give or take, on the day. We're having one of the best starts to a year we've ever had, and we're overweight equities. You think, how in the world do you guys do it? Because of the way we're positioned, having a lot of international, having the other bucket stuff, not just in bonds. So just stuff to think about. I've gone a little tangent, but hopefully that was interesting for everybody. So this time is different. We produce a lot of oil thanks to shale that we didn't ever do. So this is stuff that hopefully listeners on this call will like. The spring is coiling here. We haven't gone anywhere. I mean, S&P hasn't gone anywhere really since Halloween, since the Fed cut interest rates October 29th. That's when tech peaked on a relative basis. Now, the crazy thing, Bespoke has mentioned it. You guys have probably talked about it. Like 22% of all stocks are up 20% or down 20% on the S&P 500. That's more than 100. My math's right. More than 100 stocks in the S&P 500 are up 20% or down 20%. There's only a handful, not a handful, but like 25% of stocks as of last Thursday, at least, we're up between 5%, down 5%. So kind of around break even. That's not a lot. If you said the S&P's flat and you're telling me only like 150 stocks, give or take, or something like that, or in between that goalpost of up 5, down 5, you think, well, what's going on here? It's because we have such dispersion. It's because we have energy and materials and even industrials at 14% for the year. Now today they're going to be lower, a little down from there, whatever. And then you've got the tech stuff, and the four largest groups, right, are technology, communication services, healthcare, and what's the other one? Consumer discretionary. They were all down on the year as of Thursday. Had a little bit of put it this way. As of today, they're all going to be down on the year. Yet the S&P is virtually flat. That's because the other stuff is really doing well. Now let's smush this together, but the market's going sideways. This is wild. The first 2 months of the year, I thought things were boring. So I crunched these numbers. They're really boring. The S&P 500 is trading in a range of 2.7% from peak to trough the first 2 months of this year. Going back to 1928, using FactSet data, that is the smallest range in the history of the S&P 500 to start a year. Now, listen, I can probably find 2 random years and 1 year here, 1 year there. It's just what we're using. But I think that the reality is we are going to see more volatility coming, right? And the big question is it going to be an upside breakout, a downside breakout, maybe a downside shakeout and a breakout? Listen, we're still overweight equities. I do think eventually it's going to be to the upside here. But the reality is we have been spoiled. We've had the individual stocks making huge moves. We all get that. But we haven't had a lot of markets, indices having huge, significant moves. I think that's probably going to be coming. I mean, think history doesn't repeat itself often rhymes. When did all that crazy stuff start? Last March. I mean, last March, all the crazy stuff started. I know Liberation Day did it in April, but a lot of that volatility started in March. And that's something to think about. Now, some more good news. When the NFC wins by double digits, stocks love it. For the year, higher 19 out of 21 times when the NFC wins by double digits. So there you go. There's the analysis we all come to love and really, really matters. This is a good one. The last 20 years, this is one of the things I was talking about literally all the time last month. Banana peel month, banana peel. I think people got sick of me saying it. I said, listen, this is a banana peel time when weakness happens. It's that, the second half of February into early March. That's where we are. And I know this is the last 20 years, so it is skewed by 2020 and 2009. We get it. I get it. You get it. But still, just something to think about, though. We're in this time frame where it makes sense. And listen, the headlines aren't good. I mean, we see the headlines, crude oil's up, global market. I mean, most European stock markets down 2 to 3%. Now, listen, they're up double digits, so they're probably due. U.S. down 1.5% on S&P 500. I even saw gold. Gold's down like 2% today. Silver's down 7%. I mean, that's okay. Is it truly a risk-off world? I don't know. Everybody's going into oil, apparently. But anyway, the reality is we are in a potentially little bit of a seasonally weak period. So just something to think about these next 2 months. I'm doing time-wise. We're good. These next 2 months are historically strong. No, you don't blindly invest in this. What's my buddy Sam Stovall said? Seasonality isn't gospel, right? Use it as a guide, not gospel. So just something to think about. And listen, last year, April wasn't good. I get it. Now, funny thing, we almost finished higher last April because we had an enormous reversal. But still, if you went into April saying I'm all bullish, that was kind of rough until about the middle of the month. But the truth is, again, these next couple months can be positive. Some interesting look at a couple more. Interesting look at how things are going with the Dow right now. There's the Dow and the S&P and NASDAQ. We get it. But the Dow is higher 10 months in a row. It was barely higher last month. There's a couple other months it was barely higher. But it still counts. It still counts. You can see in the bottom right, this is one of the longest win streaks ever for the Dow in terms of monthly win streaks. And if we were to be higher this March, which I don't think it's as crazy as it sounds, if we get some good news out of the Middle East, that'd be 11 months in a row. My math is right. 1959 is the last time we had an 11-month win streak. So we are due for a down month. That's just how it is. But check it out on the upper left. When you have a 10-month win streak, what happens next? Median, what is it, 14, 16? Median of 16%. I get it. Small sample size. If you're a pure statistician, you say, it's not relevant. Throw it out. I don't like to do that. I still like to look at this stuff. So just know that, these long win streaks tend to happen in bull markets. Kind of obvious. Bull markets tend to trend higher. I think we're still in a bull market. Just something to think about. Worry spiking. And this is before this week, right? We saw the VIX going higher. Well, okay. The VIX knew what was going on with all this stuff. But two weeks in a row of more bears than bulls in the AAI sentiment poll. That's the first time we've seen that all year. That bottom left, institutional investors 2 weeks ago, so think hedge funds, they sold like the most equities they've ever sold, according to Bank of America. You've got the record amount of shorts from hedge funds on the software names there in the bottom on the right. And then the NAAIM active managers has the lowest exposure to equity since May. It was May of last year. That doesn't mean we can't go lower. Doesn't mean you can't have a little more pain. But I think we're seeing some of these things that you want to see when you have a lot of negativity. What's the old saying? It's hard to get hurt when you fall out of a basement window, meaning if there's a lot of negativity, it's hard to go much lower. But with this Middle East news, I mean, things can change in a hurry. But still, just something to think about here. So some other big picture stuff that I think is important. Equal weight, all-time highs. Advanced decline lines last week. Various ones hit all-time highs. NYSE, S&P 500, small caps, mid caps. I mean, these are breadth leads price stuff. I love talking about that. Global stocks are ripping higher. Was it that? The FTSE All World ex-US higher 10 weeks in a row. Maybe what I said, Europe's down 3% and emerging markets down a lot. Maybe we're due. Maybe they were due for this. That's why you want to have a little bit of both, in my opinion. So those are some things. Yeah, some things there. What else we have? Oh, dual tailwinds. Small caps, no, wrong word. Earnings and profit margins continue to hit new highs. After NVIDIA's earnings last week, we're looking at 14% year-over-year fourth quarter growth, way above the 8% that people thought. Earnings drive long-term stock gains. Higher profit margins help long-term stock gains. Those two things are still in place. And again, why we are optimistic, this is still a bull market. I think it might be my last one. So let's talk about risk. I mean, inflation. I've come on with you for a while saying I think we have more of an inflation problem than other people think. I think the Fed's going to cut later this year. Yes, because there's probably an agreement. You give me the job, I'm going to cut for you. But the reality is we are seeing issues with inflation. And how do we manage real money? Well, like I said, we have less bonds than a lot of other places. We have more commodities. We have more real assets. Yeah, we own stocks too. Stocks actually do okay when inflation's higher, but there's other things that do better. So this is a cool chart Sonu put up, and I'm not crazy about these charts. Well, if you look at this one, look at this one. But, we're still going to share it. We are seeing pockets of inflation going higher. You think like durable goods, like a TV or a computer the last 20 years. Well, they're all cheaper, right? I mean, that stuff's always, not always, but that stuff's usually been cheaper year over year inflation. it's starting to go higher, right? That's just one example of this. But services is a little hot. Just commodity prices. I mean, they going up or down. I know there's something called trueflation. I know there's some people that say that, and I get it. AI should be extremely deflationary down the road. I guess we're talking the next 1 to 2 years. It is what it is. I think inflation is a little bit more of a problem. We're going to live in a 3% inflation world and a 2% inflation world. So the way we think about the world, that's how we construct our models. But Sonu's got this chart. We don't think we're going to have a soaring, massive 9% inflation, but just something to think about. All right, guys, I guess I made it. Now, this is when I say, are you still here? Because I don't want to just talk to myself for the last 5 minutes. Okay. All right. No, that's however that was. All right, I'll take a breath. Hopefully you guys liked it, but that's the literally stuff Sonu and I did yesterday with our partners. We call them partners, our advisors, for like an hour. So I did it fast, but I wanted to share that with you guys.
Ryan, so many questions here, and there's just so much information, and that's why you're a plethora of information. We love it. Really, like when we're summing up a lot of this presentation, like, you got the Dow at all-time highs and RSP moving higher, and, margins, corporate margins and profits. It's really been the tale of like, and I've been saying this for a while, is where value stocks have really picked up, the slack. Like the S&P, like to your point, hasn't went anywhere. And if you lift up there under the hood, there's been a lot of stocks that have really been hammered. Some stocks down 30, 40, 50%. These stocks that were trading at 100 times earnings and probably never should have been there. And then what they've done is they've taken, the stocks were 10 times earnings, and they've expanded those multiples up. So basically, it's just like a balancing act, value versus growth. And value has just been on fire here now for 5 months straight. My question to you is, does this value market, which has driven the market for the last 5 months, continue? Do you think like value stocks, like, because every time value stocks rally in the last 10 years, they get there 3 months, 6 months, and it's like, and then they get forgotten, and the storied stocks take off again, and value gets down to the gutter. Is this value rally for real?
Well, that's a good. First things first. You a little under the weather? What, you sound a little congested, buddy. What's going on there?
This has been, so I was off the show almost all last week. I did do Friday's show, but I have been like sinus. I think I've got a full-on sinus infection happening down here. So
man,
it's fun. But that's the winter time. We're gonna get out of the winter. I'll be fine. So I'm fully congested. So
I actually go to Arizona. So I live in Cincinnati, Ohio. I'll be in Arizona in a couple of days for work. So I said I'm not very smart, but I'm also not stupid. I go to Arizona, California, and Texas a lot early in the year, and I love Chicago. I love New York. I go there like April through September. But anyway, great question. I do think there's some opportunity and growth. I mean, how are we positioned? We're more even weight, both of them. We're not making a big bet on either one. We like the cyclical areas a little bit more. I mean, we have a decent amount of industrials. Those have done well. But I think it's fascinating. You guys probably talk about this, but I'm going to bring it up. The magazine covers. And no, we don't invest on magazine covers, but I love a feel for what's going on. So at the end of last year, Time Magazine, the Time Person of the Year, the AI architects, all the big names of everybody with AI, touting how great they are and how great they've done, how much money they made everybody, and all of that was true. I saw that in the middle of December last year and said, oh my goodness. I'm not saying it was shades of Jeff Bezos, Time Person of the Year back in 99, but I saw some of that. I said, I bet that bar is darn high, and those groups struggle. Maybe not the whole year, but they struggle some. Well, that's clearly happened with all 7 Mag 7 names lower on the year. Did you guys see the one last week? Time Magazine, people versus AI. Like, it showed all these people real mad and scouring about going after. So listen, the sentiment change from AI is the greatest thing ever to the people versus AI in about 3 months has caught my attention. And I look at the record shorts on software, and software relative to S&P is the cheapest been since 2013. We have a decent slug normally use, decent portion, let's use a decent portion of technology. 2 weeks ago, we took 2 or 3% of that and did move it into, if I can't mention which one, but into one of the software ETFs. No, I'm not trying to catch a falling knife, but I think 6 to 9 months from now, we're going to look back and think, wow, people really went into staples at 50-time earnings and drew out the large cap tech, which I get it. I mean, there is no doubt about it. AI is changing things. There are certain software companies that are in trouble. I was going to use a different word. I'll be PG, that are in trouble with what's going on. That doesn't mean all of them. And I get it. But that's one of the nice things about the world I live in, probably a lot of listeners. I don't care. I shouldn't say don't care. But if stocks are down another month from now, if software down, that's all right. Like we're thinking a little bit longer term. We're not trying to pick the lows here, but we do think, Dennis, that there's an opportunity here as people have just gone all in on Coca-Cola. Nothing wrong with Coca-Cola. I'm a fan of Coca-Cola, whatever. But those valuations are nuts. And then you look at the Mag 7, which are cheapest they've been in years, and they still make a blank ton of money. Last I checked, Mag 7 earnings of 27% in the fourth quarter year over year. Listen, all right, well, the stocks are down. I get it. But there's still some moats there. So to us, don't panic. Don't go all in on the staples and defensive stuff. Stick with, the diversified portfolio is how we're looking at it.
Awesome stuff.
Yeah. Great question.
All right, Ryan. I just wanted to mention Facts versus Feelings podcast.
Yeah.
They can find you over there on like Apple, Spotify, YouTube, right?
Yeah, so Facts versus Feelings is our podcast. Type my name in or just that, and you will find it. We're everywhere. Then Carson has a YouTube channel, Carson Group YouTube. We do it there as well. It's a weekly podcast. We're starting to do more live streams as well.
Nice.
We're starting to really try to up our game in the podcast world. We were named one of the top 23 podcasts by Michael Kitces for financial advisors. He's big in my world, which is cool. And we've definitely hit a lot of downloads and listens. Sona and I talk about everything you and I, we just all talked about and have a lot of fun. But guys, I'm such a fan of what you guys do. Hope you get healthy there, Dennis, and I can't wait to come back and talk. But this was fun, guys. Thank you.
Thanks a bunch, Ryan.
Awesome. See you guys.
All right, folks. I want to just say thanks to our wonderful sponsor, Hive Digital Technologies. Hive is pioneering the digital transformation through AI solutions and Bitcoin mining. There's a little banner on screen right now. Scan that QR code. It'll take you over to hivedigitaltechnologies.com, or you can just type that into your browser. I'm going to pull up the Bitcoin chart here real quick. I just got to get back and share. Give me 1 sec.
I actually like the Bitcoin chart here. We are doing the same thing we did back in November, December, and we actually did resolve to the downside eventually here, and we might do that again. But it's still like you've got a level here now. So on IBIT's maybe the best one to bring up here. Bring it up on the daily so we can see the last 3 months there, Brentster.
Yeah.
We'll let you do that. Get you a 3-month chart here.
She's up there, right?
Yeah, kind of, I guess. So anyways, we were at the consolidation station November and December. You can point that out on the chart, that whole area.
Yeah.
In January, and we kept trying to rally, and eventually we cratered and it obviously went down. So, I mean, we're back to consolidation station again. And if you're a trader, consolidation station is where you place your bets. You're not like, if you're a trader and you're sitting there chasing, I've told this story before too, like this guy, when I first started brain trading in 1999, was sitting beside him and he just chased everything. He'd be like, something was going up. He's like, oh, this is moving. I better go get in. And then it would reverse on him. Then he'd be like, oh, this is moving. I better short this. It's going down. I short this. And then it would reverse on him. And then it would reverse on him. And what I learned quickly is chasing is just not the place to place your bets. It's consolidation station. That's the place to place your bets. And I bet at Bitcoin is actually in consolidation station here right now. We're between 35 and 40. Obviously below 35. It's Katie bar the door, probably going lower on the IBET. About 40, maybe we start to break out. But we're right in the middle here right now. So it's kind of like place your bets. I'm not going to try to guess maybe which way here on the show. But I think like at least, you're at a point now if you wanted to make bets, this is the time. So, do we eventually resolve lower on Bitcoin? I mean, it's been an ugly, ugly downtrend. Usually the predominant trend is dominant where it will end up resolving lower. But there's a lot of people who believe in the Bitcoin story. I'm still long holding some Bitcoin here. And if you're looking, buying it here, well, you've got a level lead on it. The level is $35 on the IBET.
Let's do a couple quick ratings here, and I do want to pull up the fly. We can take a peek into the fly and see what some of the color that they have. A couple ratings that we had on our radar: XYZ upgraded to buy at HSBC. Also, Unity ticker U upgraded away from sell at Bank of America. Let's start off with that one. I'll switch over to fly Triple D. Give me 1 sec here. StreamYard doesn't make it the easiest to like switch between. It's kind of annoying. I wish it was easier, but
can we play the little fly rate the ratings? Let's go.
Oh yeah, I totally forgot. Thanks for the reminder.
We'll do the same segment. Yeah,
cool. All right, a little color here. You want to start with the Unity? Cool with that?
Because this isn't an upgrade to buy, but it's an upgrade to like say, hey, it's overdone. What Ryan was just saying here. Same thing, where some of these software names are just ridiculously overdone. I mean, is it over for Unity? Is like everything that they do not needed anymore because we have Claude and obviously Gemini and everything else that we're working on here. I don't know if that's the case. So
Yeah.
am I in here making the bold call? I respect the call. So read us the color here. I respect the call though.
$19 price target here. Unity by BofA, weaker than expected Q1 guidance has likely deflated buy side's calendar year 2026 estimate, reducing the risk of further cuts while near-term catalysts appear balanced. The firm would look for aggressive Q2 guidance to signal the beginning of sustained growth segment acceleration. You give it an R for respect?
Yes, an R for respect because it's a gutsy call. I mean, here's Unity down from $48 at the start of the year down to $18. And they're basically saying, look, a lot of bad news is priced in here. These stocks oversold. It's ridiculously oversold. It's so oversold. Like I don't track any of that crap because I don't use any of that stuff. But you can just look at the chart and say, oh my God, it's so oversold. You have a level. Your level, 1678. So you could take a shot here. I used to own this stock. I mean, part of me thinks, yeah, you know what? Software, it's time to come in here and buy the dip on some of these names. I like what Ryan was saying to a certain extent there. And I could get on board with that trade here too. I don't know where we're going. Nobody knows, but you just, you take educated bets and you stay diversified here. And I don't mind that, at least they're coming in here and like trying to defend a name that's just been ridiculously punished.
And let's do one more here quick. We're going a little overtime. Thanks to the Fly for helping sponsor this segment. Let's do Block, upgraded to buy from hold at HSBC. $77 price target. They raised the target from $70. The firm, quote, materially increased earnings estimates after Block's Q4 results to reflect accelerating profitability. The company's job cuts are not coming from a position of weakness as the business and financial performance are healthy. Investors, HSBC sees 20% upside in Block shares following the sell-off in 2026. And something that is notable here is we've gotten a few analysts commenting on Block since the earnings report, and much more importantly, since the job cut news. And as far as I can remember, HSBC here is actually the first firm to mention the job cuts at all. All the other sell-side commentary that we've heard so far was strictly related to the earnings results. So I like that HSBC is using the job cuts for a little info here. I probably give this I don't know. I think I give this like a C. What do you think you would rate this one, Triple D?
An F. I give it an F because
you hate this
some
one.
of us, they just read right from Jack Dorsey's comments here. So like, this isn't like enlightening hero. It's coming from a position of, it's not coming from a position of weakness here. This is Jack said. He just really led the Jack report. Now you're hopping on board. This is called buying the rip. This is what they're doing. They're buying the rip. We don't buy rips, we buy dips. The stock just popped from 50 to 65. Yes, it's great. They're cutting the workforce. They're going to have more efficiencies. But like we said, it was a bloated company here. A lot of people pointed that out. But this is still a crappy company. This is still a crappy stock. It's a company that's changed their name so many times, I don't even know what the name of the company is anymore. So I don't like the stock at all. I would sell the rip here. Yesterday, obviously, bounced back here. I don't think this is a turnaround story here. I think this is a company that's, getting, and obviously even ripe for AI disruption here as well. So I look at PayPal, I look at this whole sector and think, why do I want to be a hero and call a bottom on XYZ? I'm out. Not for me.
Triple D, we're going to go over to STN here. I want to give a real quick preview. We're going to be having Pete Carmesino from Chaikin Analytics joining us in the STN room at 10 a.m. At 1 p.m. today. It's a Tuesday, so we get the trading edge with Trader Prad. Triple D and I will be back for the close around 3:30 in the STN room, and Money Mitch show How to Swing Trade with Money Mitch, 7:30 p.m. tomorrow morning. On PreMarket Prep, we're going to be getting Laura Chico from Wedbush, one of our favorite drug, biotech, pharma analysts out there.
Awesome.
Folks, hope y'all had a good start to your day here on PreMarket Prep. Good luck out there if you're trading midday, and we'll be back with PreMarket Prep tomorrow.